This video is for educational purposes only and should not be considered financial advice. The magic of the new day opening gap. One of ICT's key concepts is the new day opening gap. It helps frame your day trades so that you can have a bias going into each day that you place your trades. The new day opening gap forms just as the market closes at 5 p.m. Eastern Standard Time for the Forex and futures markets and reopens at 6 p.m. If there is no gap of more than a pip or a handle, then ICT does not use it as anything meaningful. Also, when the week is over, he doesn't use any of the new day opening gaps from that week going into the next week. You can use the new day opening gap with the new week opening gap that starts on the previous Friday's close and the current Monday's open. This will give you a detailed framework for areas of liquidity and a possible weekly bias. The best way to use the new day opening gap is to frame your trades around the kill zone sessions that use the optimal trade entry, fair value gap, and order block entries that overlap with the new day opening gap. Let's take a look at some examples. Here we have the start of a week on Monday in the green section. Draw out your new week opening gap and extend it until the end of the week. Then you would draw out each day when you have a new day opening gap. There is none here because there wasn't a gap on Tuesday. On Wednesday, we did have a new day opening gap, and on Thursday, we had a new day opening gap. There was not a gap on Friday. Let's take a deeper dive into what happened this week. So you would use the smaller time frames, like the 1 minute chart, to draw out your new week opening gap, and then your new day opening gap as well. And we've talked about the new week opening gap in our previous video. You can see how price reacts from the new week opening gap multiple times on a Monday. And then on Tuesday, it's also a draw on liquidity. Then the new day opening gap on Wednesday creates a bouncing off point during the New York session for price to go back down to the new day opening gap and then move towards the new week opening gap. On the Thursday, a new day opening gap is created and price uses it as a bouncing off point during the Asian session, goes above the new week opening gap, and then returns to the new day opening gap during the pre-New York session. Then comes up and grabs liquidity from the London session and then rockets down past through the new day opening gap of Thursday and Wednesday to make a new low. Then price returns back to the new day opening gap on that Wednesday and moves through the Thursday new day opening gap, using it as a jumping off point towards the new week opening gap. Price dips down one more time to the Wednesday new day opening gap and then bounces right back through Thursday and takes out some more liquidity above the new week opening gap. Then the week ends inside of Wednesday's new day opening gap. As you can see, watching price throughout the week, you can watch it move through the various gaps from each day. And if you were watching the trades that you were in and wondering why it paused on this level, you would understand why. You can also see here, right at the London session, this could have given you your reason to exit a trade if you had entered in the Asian session, moving to look for liquidity resting below here. Let's look at another week. Here we have a new week opening gap on a Monday. Price moves away from it during the London and pre-New York session, then returns right back to it as a draw on liquidity during the New York session. You could have framed a trade here, looking at price breaking structure, going back into an optimal trade entry, or inside of this fair value gap, and then moving downwards towards the new week opening gap. Now, a new day opening gap happens on this Tuesday. We look at the Asian session, using it as a place to bounce off from. Then right before the London session, price dips right back into that new day opening gap and then takes off past through these equal highs. Price continues to the upside, and on Wednesday creates another new day opening gap and consolidates around it. Then it closes below and moves back towards Tuesday's new day opening gap. It does not reach it, but continues to the upside. Now here from our previous video, you can see where price reaches down to around 50% of the move between this large impulse and the new week opening gap. Let's draw a Fibonacci from the new week opening gap all the way up to the top of the impulse leg. Here you can see a move down to 50% of this impulse. Price digs into the 61%, then rebounds past the 50% level, and then continues higher. Once again, during the pre-New York session, price closes above this new day opening gap from Wednesday, and then dips right back into it, right into an order block. You can frame your trade around that. Price bounces off to the upside. Then on Friday, price creates another new day opening gap and then consolidates around it. You could have used that to frame this trade that happened pre-New York session. This order block here became an area of rejection. Price traded through the new day opening gap from Friday and closed above it. That would have been a good entry to move to the upside. To recap, the new day opening gap is a great way to find draws on liquidity and to understand why price is behaving the way it is. By drawing the daily opening gaps, you will be able to navigate price action more precisely and be able to enter and exit trades at the right time. We hope you've enjoyed watching our video. Please like and subscribe for more videos like these. If you have a question, comment, or something you would like for us to cover more in depth, please post it in the comment section below. Thank you for watching.